The Money Show. Personal finance.
Warren Ingram from Galileo Capital. He's a financial advisor. He's a director at Galileo Capital. The water, of course, ran out in Saturn. Cape Town is close to running out with water. What if the investment water runs out? We've had a dry run, so to speak, of all the bad news.
Yeah, I must just tell you, at least I managed to get a shower today.
And that's a relief
to
everybody around you, Mr. Ingram. Everyone around you is incredibly grateful.
So you're right. We in this absolute dead patch, dry patch at the moment as South Africans looking around and wondering, I guess it started today, with the ratings agencies, the first one's coming out. We expect more tomorrow, and then we've got the ANC elective conference in December, and then a little national election in 2019, and many of these things that are on the horizon, over and above everything else that we now know about in terms of the corruption that's going on. We have these very binary outcomes, yes or no answers. It's going to be one presidential candidate or another for the ANC. It's going to be, a ratings agency that says we downgrade you, we hold you. They're certainly not going to uprate us at this stage. So it's a downgrade or a hold. And all of these are major, I would say T-junctions as opposed to a fork in the road. And when you sit in an environment like that, to make sound, rational, long-term investment decisions becomes incredibly hard. And I feel, if I listen to a lot of the questions that I'm getting at the moment, a lot of the discussions that are going on around investments, that's exactly the mindset people have right now is, it's either this way or that way. And that's the only, we can only go one way, and that's the way I'm going to invest my money. And I feel that whenever in that kind of T-junction world, that's the opportunity to make some really big mistakes, and that's what we need to avoid at the moment.
Okay, so there's also, it's often the case that things are often never as bad as we fear they will be, and things are never as good as we think they're going to be. The world doesn't work like that. So at the moment, the world is sort of telling us that there is going to be a dreadful disaster of an ANC electoral conference, and it's going to go terribly badly for markets. That ratings agencies are going to downgrade us, that the rand is going to blow out, that we are going to see a spike in inflation, that we are going to all be poorer by this time next year. That part of that, all of it may be true, but how on earth do you brace yourself for all of those scenarios?
So I think just to talk through, I guess, some of the options that you have and the main asset classes that we would all invest in, whether we did it via share portfolios, exchange traded funds, or unit trusts. Ultimately, these asset classes are all, the building blocks of those investments. So I think the first one will be around the rand specifically. What's going to happen with the rand, and I mean, I think just to start with, the answer is we don't know. But if we look at the two kind of, if we hit a T-junction, the positive scenario, the negative scenario, the likelihood is if we get a downgrade, the market reacts, the currency market reacts quite negatively to that, and we see the rand go down in the very short space of, a very short sort of future just after that. And if we look at what happens in other countries that have been downgraded, where their currencies are allowed to float like ours is, we don't have a manipulated currency, then what you find is that a few weeks after the market starts to stabilize and settle, and that exchange rate actually starts to go up again, because people have now had a chance to analyze the new reality, the new facts as they know them, and they start to make a decision about whether this is a good currency to own because of the interest rates. And I think that's the important thing here. We are in an environment where investors, especially international investors, if they can find a way to hedge their currency exposure, they can get a very nice interest rate on their money, whereas they can't get that overseas. And so this is an attractive place still for international investors. So I would say, people who are saying, this is a one-way bet, just get your money rand-hedged as fast as you possibly can. Well, I mean, my view is either the rand is particularly cheap or particularly expensive right now, depending on this T-junction scenario. So don't just pile in there as starting tomorrow, for example, if we get downgraded, and just sell all your rands and buy international investments, and sell your house and sell your car and just buy overseas investments, because the likelihood is, if we follow patterns that we've seen around the rest of the world, we could be in a space where the rand is significantly stronger again in weeks or months' time. So I think as a starting point, please don't go now and bomb all your rands in one shot.
So what do we do?
to me, I hedge that. I hedge my bets in a scenario like this. So if you've got nothing overseas, if you've got zero rands invested overseas, then at least try and get some rand hedge exposure. In other words, if you don't have a lot of money to invest, that means you could go and open up an account with a stockbroker, one of these online guys, and just you can hedge your rand. You could buy rand-based overseas investments. That's quite an easy thing to do. Whether it's an exchange-traded fund or a share that's listed overseas. Get some exposure. That makes sense to me. So, and I would say, at the very least, all of us, in one form or another, need about a quarter of our investments, at the very least, invested overseas. And often, if you just buy a balanced unit trust, it's got a quarter of its investments overseas. Any kind of an asset allocation type unit trust would have about a quarter overseas. So you could just do that if nothing else. But you can do that, and you can do it very quickly with an online broker. So I think as a minimum, a quarter of your exposure needs to be out of South Africa, but not 100%.
Okay, now the bond market. Now this is a place that scares a lot of people. The bond market is where companies and governments go to borrow money. And also, if you have a pension fund, you already are exposed to the bond market. That is the biggest market for buying bonds. You already are there, courtesy of your pension fund.
Absolutely, and again, if you're in a balanced fund, you've got exposure to bonds as well. It's a very interesting market right now because they always, in investment world, they call that the 800-pound gorilla. That's really the very big market that sways entire countries, entire governments can fall over because of the bond market. If our government cannot raise money in the bond market, it cannot survive for weeks. Forget about months or years. So the bond market really is the major factor in all investment markets. And I think in the short term, I think also just to understand about the bond market, that's possibly, and with respect to the people managing shares, that's probably where the brightest people are, is sitting in the bond market. And so they're not sitting there waiting, twiddling their fingers and sitting on their hands, waiting for ratings agencies and waiting for elective conferences to happen in one direction or another. They're trying very hard to anticipate what the outcome's going to be, and then they make their decisions, which then reflected in the bond, the prices of bonds in the whole bond market. Mm-hmm. So again, if we are downgraded tomorrow, then the likelihood is that we then get kicked out of the World Bond Index, and that's bad, because that means that index tracking funds around the world will need to sell the bonds that they have in South Africa and get out, because their mandates will force them to do so.
And what's been so comforting about being part of this WIGB, they call it the World Bond Index, has been that there's been this very steady flow of $3 or $4 billion a month, every month, a bit like a comforting investment return that just pops into our markets every single month. Tick tock, because the world is obliged to buy our bonds. The moment somebody is forced to do it, well, they run screaming.
Well, and that's the interesting thing about markets, because I mentioned that our interest rates are very good, and that's certainly reflected in our bond market as well. So what you'll find is the index tracking bond managers, yes, they'll need to sell, but then you'll get the next category of bond managers, and those will be the ones that perhaps unkindly are called the junk bond managers.
It's the best way to describe them. I don't think it's unkind. I don't think they mind, do they? They make lots of money. They don't mind what you call them.
It's exactly. It's okay to cry in your Porsche.
Exactly.
And I think what they'll be doing is they'll be looking at this and saying, okay, so now this is a reality. We people were anticipating what was going to happen. Now we know the new set of facts, and actually those yields that we can get on the South African bonds are now 10 or 11%. If that's what happens, We think the currency's had its knock, and therefore we don't have much currency risk. So we can go and go into the South African market and get, let's say it's 10.5% yield on our money, and we can only get 2% at home. Gee, this is a buying opportunity. So I think that's the important thing to understand about that bond market. And also, international bond buyers of our markets are quite small. I think it's about 11%, if I'm not mistaken, in total. And what we need to understand is there's a huge South African bond fund or bond market, with local banks and local fund managers who will be looking at our market and saying, if we can now get 10 or 11% yield on bonds in South Africa, and we're only expecting shares to give us 12 or 13, well, we'll take the bonds.
Yeah.
And so there will be a natural buyer here. So again, my comment to people is, don't think that because we get some bad news that there's only going to be one outcome, which is massive disaster. That's not necessarily the case. Clearly, over the long period, over the longer term, it's terrible for our economy to be downgraded. I'm not disputing that, but that's not the same as making a rational investment decision.
Yeah, Sorry. I wanted to interrupt, but carry on.
So you know, whenever I go on my long diatribes like this, you always say, so what should we do? So the answer is, in this instance, if you're a holder of bonds right now, I would say a lot of what's going on in the markets, a lot of what might happen is possibly priced in already. Yes, there'll be a little bit of movements around, but I would be looking through this and saying, what happens in 3 or 6 or 9 months from now? Don't really worry about the next few days or weeks, because these outcomes are so binary that I just don't think it's worth making that call now.
What strikes me about South Africa right now is that there's a huge amount of apprehension, there's a huge amount of fear, and anybody who claims to have an answer as to this person's going to win or that person's going to win is listened to with a great deal of interest. And today you might be thinking that Willem Kiese is going to take it. Tomorrow you might think that Cyril Ramaphosa's got it. The next day you'll think Nkosazana Dlamini Zuma's got it. Maybe even Baleka Mbete you'll think is in with a chance. And people are thinking themselves or panicking themselves into paralysis.
And you know, I think, you know, I have to pick on somebody today, and that's going to be the political analysts, because, you know, I think there are more political analysts in South Africa than there are people right now, and it's amazing. You know, I don't know where they all come from, but and what their backgrounds are, and why they've suddenly got expertise. But we need to learn a lesson from political analysts in particular, and that is just look at how convinced political analysts were that Hillary Clinton was going to win and Trump was going to lose, and how convinced those self-same group of analysts were that Brexit was never going to happen, and it did. And time again, these wonderful political analysts around the world, South Africa is no different, give us these massive, very firm views about exactly what's going to happen, and they are completely wrong. And to me, right now, if you want to make an investment decision based on a prediction by a political analyst, rather go and get a coin from your wallet, flip the coin, choose heads or tails. You've probably got a better chance of being right compared to the political analyst. Don't give them a massive weighting in your investment decisions. It's a terrible idea.
Final thought on stock markets and investments. So many of the adverts that you see all over the place are offering money market accounts, offering deposit accounts, and very attractive rates of 8 or 9 or 10% in some cases. Here's the problem with that. And I was chatting to David Shapiro about this off air yesterday, and just in a broad conversation about markets. And he was saying one of the great tragedies of his long experience in markets and 4 decades of experience in markets is looking at families who in the 1960s and 70s lived in places like Houghton and were amongst the super rich and in the sort of Joburg elite of the time. And they started great businesses, some of which are still with us today. But they sold out their businesses into growing corporations. And they were concerned about the future of South Africa. So what they did was they put all their money in the bank, and they put them at high deposit rates. And many of those families today, he maintains, are in some cases quite impoverished. And it looks at that as being the absolute tragedy of people not wanting to invest in markets.
You know, if I look at the South African stock market specifically, I mean, it's so massively hedged against a weak rand. You know, if the rand just carries on going down, you know, because we get a whole lot more bad news, you'll find that our stock market will go up. At the same time, there's a huge part of our market. If I think about the banks and the insurance companies specifically, that have been absolutely hammered for the last couple of years. And if we get positive outcomes, what you might well find is that part of the market goes up nicely from here. So to me, you know, to get out of the equity market now is a huge mistake. And if anything, if you don't know what to do and you've got capital invested, surely you don't keep it in cash. You know, I think the market's just not a bad place to be right now.
Warren Ingram from Galileo Capital.